Hi everyone, this is Mayank and welcome back to the channel. So last time we discussed about a proxy of infra sector, the cement sector basically, and then we discussed about a particular stock from that sector. Today also we'll discuss about a proxy of the infra sector again. So you can see a lot of things are going in infra sector, right? Railways, bridges, roads and everything. So today also the same concept lies, a proxy, and the proxy will be across the sector. So it's not a proxy only for roads or transport or maybe for railways, but it can be used across the sector for power generation to, for example, renewable power setup, then your industry setup, and then your railways and everything like that. So this particular company is very interesting because they generate a net profit margin of 30% and a gross margin of 60 around 60%. So that is not very common in the case of all other companies. If you see, very few companies are there who generate a profit of around 60%, and then infra sector. If you see IT companies, it's fine, they generate a profit of 60%, 65% gross margin. It's a common thing, but any infra sector company generating a profit of 62%, 60% gross profit, that is not very common. And then on top of that, 30% net margin with not very significant debt is also not very common. So this stock is very unique, and but this stock has rallied a lot in the past, and but now a lot of things are happening in the stock. So we'll discuss about the what this company does and what kind of capex and things like that it has plans, and we'll discuss about the risk also that is can be associated with this particular stock. So let's jump into the stock directly, and we'll discuss one by one all these things. So the stock what we're going to discuss today is Sangvi Movers. So Sangvi Movers is the business of renting a crane. So renting multiple cranes basically. And now recently it added also a business of EPC vertical. So we'll go a little bit about that. We'll see. So basically Sangvi Mover is engaged in the business of providing hydraulic and crawler cranes of various capacity from 20 tons to 200 tons. Okay, and it has more than 300 cranes in their entire bucket of renting. And recently, they also forayed into the EPC business. If you look at the fundamentals, they're very straightforward business. They buy crane and they rent it out to all different construction companies, both private and government. And then they make a renting out of it. Okay, so it's not a very manpower intensive business. They just do that. Okay, but at the same time, it's very capital intensive business. Now, if you see the market cap is 4,800 crores, current price has got some correction. I'll give you the reason for correction also. Uh, Stock pace 25.6, which is not very high, but historically it's close to the median. So ROC and ROE is around 20, more than 20%, which is good. The good part is that debt is only 292 crores, where they are in the business of cranes, which is again a very costly purchase, and they have more than 300 kind of cranes. Okay, so considering that kind of investment, their debt is only 292 crores. At the same time, they make a profit of 188 crore last year. So it's this actually become make it very close to debt-free company because they have some kind of cash equivalent as well. If the debt equity ratio is only 0.29, and then the interesting part is always the PEG ratio is 0.71. That means the growth is higher than the price earning, right? So this is what the fundamentals look like. And if you go, you can go in the detail of everything. They have eventually will tell you that they rent out crane and they got involved in some kind of EPC business as well. So now the EPC business vertical is very interesting. The reason is that they didn't get into this business themselves. Their client has asked them to get into the business because they believe that they can do it in a better way compared to the clients. So what they're doing, so they are not doing everything themselves. They're outsourcing their entire EPC business to also one more contractor. So the contractor takes care of everything, manpower and everything. They're not getting their hands dirty. But since the customer has asked them, so they have a pricing power. So some kind of demand they can make, and that will add some kind of extra margin to Sangvi Movers. You know, EPC as a business is not a very high margin business. It's a very paper thin margin business, around 4%, 5% kind of 6% kind of margin. But since they have advantage, they are saying that it will make around 12% net margin. This is what the CEO of this company has suggested, right? I think his name is Rishi Shangvi. Okay, so this is the fundamentals. We go to quarterly and yearly price, the sales. So this has been doing good from 97 CR in June 2022, 109, 122, 127, 146, 140 against a dip, 167, 165. So March quarter, normally we don't see a lot of increase because the last quarter and lot of things, budget and all things comes into picture. So every March, if you see, the difference between December and March is not very significant. 122, only 127, almost just around 5 crores of sales. Same 167 to 165, it's almost like same kind of sales or -2. Similarly, if you see here, December to March, the 2020 quarter, there's a lot of jump. But historically, this has not been a great, if you see with December to March for this company. Interesting is their operating profit margin, which is now at the range of 56 previous quarter, but normally it's in the range of 60%, 69, 62, 60, 60, 61. So normally they go in this range. Okay, and then if you see the profit, it's almost 30% of their net profit. So out of 165, if you see 48 crores, this will come around 30%. So this is the, if you see yearly data, their sales has been doing good in the terms of growth. If you see for last 4 or 5 years, they are doing around this negative is was COVID, then 49%, 35%, 35%. So they're growing at a rate of 35% of growth. Now, if you see, 619 crores is something what they did last year, and their entire capex has been done. Okay, so around 350 crores of capex they already done, and this particular financial year they will do a capex of around 250 crores. Okay, so the capex will divide into two parts. Majority of them will go into purchase of cranes, and some of them around 50 crores will go into the EPC business. Okay, now as I told you, they don't do EPC themselves; they will outsource again it to some more contractor. So that's why the capex will not be much in the case of EPC, but the majority of them will go in the capex of buying a new cranes. Okay, and also they have a policy as per the government norms that they retire the cranes much early compared to the last lifespan. So they need to keep procuring cranes, and this quarter they have retired almost all the cranes which were not performing, and that's why you can say they sold it basically. Retiring means sold it, and that's why the capacity would have reduced little bit. But since they will purchase more, eventually all this new capacity will be part of the capex. Okay, I'm giving these things before because you have to go to the con call letters and everything to find this information. And then, but still, I'll suggest you to go through all this con call letter yourself, and don't take this video as a suggestion or a recommendation. You can read all these con call letters and a presentation. I've done this for this video, and then probably get a better information or a more detailed information. So this is how the numbers looks like in a nutshell. Okay, now this company had target was a target. So target is 1,000 crores. Basically, the CEO is saying they might reach around 950,000 crores. So if there is 1,000 crores, what is the bifurcation? How much will come from renting of cranes, with a high margin business around 62%? How much will be come from top line will come from EPC business, where the margin is less around 12%. This is what he's saying. So 30% net margin in the case of renting of cranes, and 12% net in the case of renting it out your EPC business, right? So this is how the next 1 year will look like as per the comment of Rishi Sangvi, right? And they don't give much of forward commentary. So there's a policy. If you see the concall letter, they tell it multiple times they are against giving any forward commentary. Okay, and one interesting point also I told you, right, why their share fell down a lot. Okay, so this fell down because some resolution they passed where they increased the commission of uh, uh, chairman or board of directors based on the profit of the company, and the company has been making good profit for last couple of years. So they've increased the commission fund 1.5% to 3.5% for the directors. So there's a lot of history behind that. 5 years back, the sales was not more. They invested close to 20 crores of rupees in the company with a very small amount of interest. So all the discussions are there. Somebody says it's not justified to raise 3.5% commission, where one part of the board of directors they say it's justified because a promoter has given a lot to the business without much of personal interest. So this kind of things you can find from Concall letters. Coming back to the numbers, if is the balance sheet, their borrowings is only 292 crores, but this borrowing is 292 crores is mostly on credit note. It's not a loan kind of thing. It's a credit note, and this is backed by their fixed deposits and everything. So they are in a position where they can repay this debt within 12 months as per the management commentary. See other assets, the other assets, cash equivalent they have already 81 crores, and their profit they made around we discussed on 188 crores. So total if you see it comes around 260 270 crore. And if you go in retail, then they have some kind of mutual fund investment of 70 crores and things like that. So total, if you see, they are net profit debt-free company. So let's look at this thread of value picker. So in this thread, I have gone through the entire thread 12 couple like 4 5 months back, and then one particular calculation somebody has done it over here. So it's good to see that. It's a very simple calculation as per the commentary from management, as per the details provided in the particular con call letter and all those things. So they are saying that out of 1,000 crore revenue, 600 crore will come from 60% come from renting of cranes, higher margin business, and 40% will come from EPC business. So this particular thing is very interesting. So net profit margin, suppose 600 crore is the crane, and out of crane, net profit margin is 30%, which remains same. It doesn't change anything. So if you see 30% of 600 crores, they make around 180 crore of net profit from renting of cranes, and Sorry, and EPC business 400 crores for 12% net margin, they make 48 crores. So total becomes somewhere at 228 crores of net profit margin FY25, and the number of shares they have is close to 4 point, floating shares is 4.33. So if you divide 4.288 by 4.33, you will get somewhere close to 41, 42 kind of, sorry, 50, 52, 53 kind of P ratio will get. Sorry, earning per share will get. So if you see 53 is the earning per share for this company, and current P is 25. So let's suppose 26 is of calculation. Do a calculation and see what it comes. So basically 53 is what we are expecting earning per share. Okay, and number of and P ratio, if it remains almost same, then the target price becomes 1378. Sorry, calculation was wrong. It was somewhere around 1378. This is what it can reach if all these numbers remain same. Now, if you see their P ratio here, right? So the P ratio was almost 51 when they got listed and dipped down further to around 15, and now it went high because it's news which came out that they've increased the commission for the directors. It plunged down, and then their EPC business will also increase the lower margin. So blended margin will be much lesser what they are getting from cranes. So all those things together had a bad news and a bad impact on the market, and this fell down from here. And the P came around 25. But if assuming that the P could have stayed over there, or maybe once they start adding more revenue to the top line, and eventually see making 1,000 crores and then 60%, 30% margin is around 300 crores of profit. But at the same time, EPC is a high value business. So if suppose they do 10,000 crores and they make 12% of that, then they will make 120 crores. And they suppose after 2 years they make 10,000 crore of business and 12% of that. So the margin overall, the amount percentage might look less, but the value of the percentage might become higher. So they are saying that down the line our EPC volume will increase a lot. So last quarter they did around 25 crores. This quarter they are doing 250 crores. Maybe if it grows like this, since their customer is demanding their EPC involvement, so this market might understand. Okay, see, eventually value wise they are doing more, though percentage is less. So if the stock starts moving in the upward direction, the P ratio start moving upward direction, then around 33, 34 is something which we can see if this happens. It's again a scenario based calculation. So 33, 34, if you see 33 around 53, then we can say target of 1749, which is roughly around 60% from here. So now the idea is that if you see all these numbers and all, right, it doesn't look like a very multi-bagger stock from now. Okay, so it's up to you whether you want to invest or you want looking for 2x, 3x return in 1 year. Then you can choose some other stock. So this stock looks quite promising for me from the numbers point of view, the kind of growth they are doing, and also they hired Bain in Capital for some kind of strategic suggestion to diversify the business or to move into new geographies and eventually increase the size of the company. So all these things what they're taking, they do some kind of digital implementation also using SAP. Then as I told, they hired Bain and company. So all these things they're doing. So this might take some time, but all these strategic initiatives might lead a bigger fruit for this company in the longer period of time. So you do your own research. If you think that this is worth investing, then you can go ahead. Or if you think that this might not be apt for your return, then probably you can leave the stock. So decision is completely yours. So this was the video. If you have watched till the end, don't forget to like the video and share with your friends and family. And if you have any comments, please do let us know in the comment section. Thanks so much for watching. Stay happy.